Hello and welcome to Owner Finance Academy, where we help Canadians build wealth by buying U.S. real estate and selling it with owner financing. Before we begin, a quick reminder that everything shared on this channel is for educational purposes only. Every situation is different, so consult a qualified legal or tax, accounting, financial professional before making your final investment decisions. In this lesson, we're going to look at one of the biggest misconceptions about owner financing, that it must somehow be a scam. By the end of this video, you'll understand why sellers, investors, and buyers all willingly participate in these transactions and why owner financing exists in the first place. Let's get started. One of the first questions people ask when they hear about owner financing is, what is the catch? Well, that reaction is understandable. Most people are used to thinking that every real estate transaction has only one winner and one loser. If someone buys a property cheaply, like you, and later sells it for more, many people immediately assume something dishonest happened. But in reality, owner financing exists because it solves a problem for a person and often solves problems for many people. Like any investment strategy, it can be done ethically or unethically. The structure itself is not the issue. The key is that every participant understands the transaction, enters into it voluntarily, and benefits. So let's look at the transaction from each participant's point of view. Firstly, as you know, in this slow flip real estate investment strategy, which this academy teaches, the goal is for you as the investor to buy a house below market value. You want to spend somewhere between $30,000 to $40,000. The first question people ask is why someone would sell you a house below what they think it's worth. Why would they let go of their property to you for $30,000 to $40,000? The answer is simple. See, not every seller is trying to maximize price. Some are trying to maximize certainty. Others need speed. Some simply want the problem gone. Remember that many properties suitable for this strategy are older homes requiring work, located in lower price neighborhoods, or owned by someone facing a financial or personal challenge. They may have inherited the property but not want it. They may have moved. They may have accumulated unpaid taxes. They may simply be tired of maintaining it. Waiting months for the perfect buyer to come along is not always their priority. So, you, as an all cash buyer who can close quickly, purchase the property as is, and remove uncertainty, you provide exactly the solution they are looking for. The lower purchase price that you pay reflects those terms, the certainty that you're able to provide. So now that you've purchased the house as the investor below market value, got a good deal, you would assume that you as the investor have to renovate the property before selling it. That's how you make your profit, right? No, no. That's the traditional flip model. This is the slow flip strategy, and it's different. The investor purchases the property and sells it in its existing condition as soon as possible. The value is not created through the renovation, it is created through the financing that you will offer. The investor is providing something that other traditional lenders in the US do not. To that particular type of buyer, they do not have the access to ownership that you will provide. That financing that you will provide has value. Just as banks earn interest for providing mortgage financing, you, as the investor providing owner financing, are being compensated for assuming a greater level of lending risk. The business is built around structuring financing, not swinging hammers. But why? Why would someone on the other end buy from you this way? This is probably the biggest misunderstanding. Why wouldn't the buyer in the US who's buying from you as the investor not just go to a bank in the US and get a loan themselves? The reality is that many people cannot. Traditional lenders in the US, just like in Canada, have requirements. They're looking for a certain kind of credit history, certain kind of employment history continuity. And in fact, most lenders have a minimum loan amount, somewhere in the neighborhood of 55, 60, or $65,000. They also expect the property to be in a certain condition. Many affordable homes simply fall outside of their price range and do not meet those condition criteria. Some buyers are also facing challenges, maybe rebuilding their lives after a divorce, recently arrived in the country, experiencing financial hardship years ago that they're still trying to repair. Others are even self employed or have gigs in the gig economy. They may be perfectly capable of making your monthly payment, they simply cannot satisfy the tough lending requirements of traditional lenders in the US. So, owner financing creates another path. Instead of continuing to rent indefinitely, they can begin moving towards full ownership by working with you, and that full ownership will be achieved when the deed is transferred from you to them. But doesn't the buyer pay more, you ask? Well, yes, in many cases they do. And that surprises people, but it shouldn't. Price alone never tells the whole story. Whenever financing is provided over many years, the financing itself is of value. Think about a traditional mortgage, even here in Canada. If you borrow money from a bank for 25 years, you typically repay substantially more than the original loan amount once interest is included. Owner financing works similarly. In addition to the base price and interest, there's also a margin of profit that is there to reflect the lending risk that you are taking over that period of time and dealing with someone who may have a challenged financial past. The important comparison is between the housing options you're providing the people, not the price that is being offered. If conventional financing is unavailable today to that person, while you providing owner financing, you're providing an opportunity that otherwise would not exist. Another misconception is that somehow your buyer is trapped forever. That isn't how these agreements generally work. See, the long amortization period of 30 years exists primarily to create affordable monthly payments comparable to what they would pay if they were renting. It's not a requirement that someone remain in the agreement for 30 years. If the buyer later improves their credit, qualifies for traditional financing, or let's say the market appreciate and they choose to sell the property, they may, in fact, be able to refinance, pay you back, and exit the agreement much sooner than 30 years. Many buyers don't make payments for the full 30 years because one of these factors happens that enables them to exit sooner and profit handsomely. So, do we as the investors want our buyers to fail? Absolutely not. A successful owner finance investor wants exactly the opposite. The best outcome is a buyer who pays you consistently, improves their financial position over time, and eventually becomes the full property owner when the deed is transferred over to them. Any kind of default along that path creates additional work for you. And believe me, it consumes time, consumes legal costs, and worst, it interrupts your cash flow. So a successful investor builds their business around long-term performing agreements. That is why many spend considerable effort doing some level of screening to make sure that they're selling to someone who can afford to pay the monthly payment. Everyone benefits when the agreement succeeds. And therefore, this is very different from a landlord agreement. Although there is monthly payment that resemble rents, that is where the comparison stops. A landlord, as you know, rents a property, but an owner finance investor sells the property using long-term financing. The occupant, your buyer, is working toward full ownership under a written agreement rather than simply just making monthly payments and washing their hands of the accountability of maintenance of the property. That distinction changes how the transaction is structured and why both parties enter into it. Someone who buys using these terms from you is looking forward to being able to care for the property as their own, to change the color of the paint and do whatever else they want to do. So, are these transactions risk free? Absolutely not. Like any investment, buyers should understand exactly what they're signing. They should know the purchase price. They should understand the interest rate. So should you, of course. They should know what their responsibilities are and the consequences of default. Investors should operate transparently. You should document everything and comply with all the applicable laws in the given state and market where you are investing. Good transactions depend on clear expectation for everyone involved. The key takeaways today then, owner financing exists because it solves problems for people. The seller receives speed and certainty. That is the seller selling to you. You as the investor, you earn a return for providing financing and assuming risk as you provide this property and financing to your buyer. Your end buyer gains access to home ownership when traditional financing may not have been available for them. When structured properly, understood clearly, and carried out ethically, this is in no way a scam. It is a service where everyone wins. It's simply another way to buy and sell real estate. The key is understanding what each party is receiving in exchange for what they're giving up. That understanding allows you to evaluate transactions objectively instead of relying on common misconceptions and myths. I hope you found this lesson helpful. If you'd like to learn the complete Owner Finance Academy system for Canadians investing remotely in US real estate, you will find a link to the full course in this description. If you're not quite ready for the full course, or you'd simply like a practical tool to get started, you can download the free Slow Flip Viability Diagnostic. It'll help you evaluate whether one property that you might be looking at this time is a good fit for this strategy. And for a limited time, we still have some slots open for the cohort. This is a free 7-week program where you walk through the entire course week by week and with a group of people learn the strategy and start to implement it in your investment journey. Thank you for watching, and we'll see you in the next lesson.